Tyler, you and I have been covering the oil and gas industry for a long time as part of our overall coverage of energy markets and energy investing. And it seems like this is a theme that happens at some point every year, a couple times a year almost. And that's investors get really, really excited about independent oil and gas companies. We've seen a lot of acquisitions in the space. I think maybe that's one thing that's got investors looking there. In particular, right now, Occidental Petroleum, Oxy, it's a big Buffett investment, big Warren Buffett holding. And Devon Energy, getting a lot of interest from investors. Devon maybe more because of its dividend and looking for dividend yield. And investors are looking a lot there. You and I both kind of agree maybe now isn't the best time to be looking there because they're not cheap. But we have some better ideas. So instead of just telling people 100 reasons why they shouldn't buy these, we've got a couple of ideas of stocks that we think that people that are looking to profit from the energy market right now and looking at oil and gas may want to look at instead. I'm going to kick to you for the first one. Before I do, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link, go to fool.com/the smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after the video. Tyler, okay, you go first.
Yeah, so one of the trends that I think you and I can both acknowledge is that American oil companies do tend to trade at a rather significant premium to a lot of their international peers, and sometimes for good reason. You and I have talked offline a lot, almost jokingly, about some of them, like BP, for example, who has a tendency to have multi-billion-dollar write-downs every couple of years because they made bad investments. And Shell, it can be a little bit inconsistent, to say the least. But at the same time, there are really good companies in the international markets that, a lot of people in the United States probably aren't familiar with, right? Because, when it comes to oil and gas, ExxonMobil and Chevron are just ubiquitous in kind of like how we see things in the United States because the gas stations are there and whatnot. But if you look outside of the American markets, there are some very attractive international oil and gas stocks that have that integrated model that you see at ExxonMobil and Chevron, but they trade at significant discounts. Why? I don't know. Because they're international companies, because they're not quite as big as ExxonMobil. There's probably a myriad of reasons, but it's a part of the industry that I have really been focusing on lately because they trade at such significant discounts relative to their American peers. And the one that I have mentioned once or twice before, but I'm going to do it again, I'm going to mention EQNR. EQNR used to be called Statoil. It's the Norwegian oil and gas giant. They have some of the most prolific and productive in terms of cost per barrel reserves in the world in the Norwegian continental shelf. I think on their last earnings presentation, they talk about, look, we can pretty much produce at $25 a barrel and be profitable and cover our dividend at less than $30 a barrel, which is fantastic from an investor standpoint, because at $77, $75, $70, $80 range that we're at right now, there's a lot of cushion before things start to actually look distressed. But at the same time, because they are so profitable right now, they've been able to return a lot of capital to their investors, either through special dividends, through buybacks, and just regular dividends in general. Combined, it's been about, if you combine all those things together, it's called shareholder yield. If you combine dividends and debt, share buybacks as a percentage of the market cap. And right now their shareholder yield is somewhere in the 15 to 20% range, which is that's the kind of thing you want to look for in an investment, right? And so
you get recent prices, you're looking at about a 17% shareholder yield. That's pretty attractive.
Yeah. And so you get that at right now, their current price to free cash flow. And again, I get it. Free cash flow for oil companies is a little hard because they are commodity companies and it's going to vacillate. But currently, at current prices, which is what I say, $75 to $80 a barrel, right now EQNR is trading for just a little bit more than 5 times free cash flow, which that seems to be pricing in a lot of downside in the oil market, which I guess is possible. But I think it's a sufficient enough margin of safety that for somebody looking to make an oil investment, this is the kind of thing that you want to look for.
Well, and comparing that to the two stocks we mentioned at the jump, Devon and Occidental Petroleum, which to a certain extent their cash flows can be even more volatile than an EQNR's. You're looking at over 10 times for Devon, and Occidental's somewhere right around 9 times free cash flows. So a substantial discount. And again, it's a company that's returning tons of that cash flow back to shareholders. But even as it's returning tons of it back, it still maintains about $1 billion, I believe, at the end of the most recent quarter, roughly a third of its market cap in cash, which is just incredibly attractive and massive margin of safety for the business, massive margin of safety for shareholders. So I think that's really, really important. I want to talk about another European giant, and I want to talk a little bit about Total Energies, which is, of course, the French super major. Again, this is a fully integrated oil and gas company. It is a peer with the ExxonMobil's, Chevron's, Shell's of the world, doing a little bit of everything across the entire value chain, from exploration and production, refining, marketing the refined products, operating pipelines, petrochemicals, all of that. One of the reasons, Tyler, I wanted to call it out is that not only is it also fairly valued, it's certainly, again, cheaper than those US majors. It's not as cheap as it was not too awful long ago, but one of the things that it's done really, really well, in addition to being just a really good oil and gas company, is it's made investments in renewables that have been both modest in relation to its size and its scale and its cash flows, but they've also generally been profitable, right? It's able to kind of thread the needle, so to speak. While we've seen so many of its peers, you mentioned BP, throw large sums of money and generate negative returns, or just not really focus on it at all, and certainly not execute really, really well. So I think for investors who are thinking about that energy transition, also looking for value, looking to get good returns and also participate in the oil and gas market today, Total Energies kind of checks all of those boxes off. It also has a nice dividend. The yield's above 4%, I think around 4.5% at recent prices. And that makes it, to me, a good combination of all of the things that investors might be looking for, Tyler.
Yeah, Total Energies, again, somebody who lives overseas has been much more familiar with Total Energies. Living in sub-Saharan Africa for quite a while, they are ubiquitous across the entire continent, across the entire value chain, upstream, refining, as well as that marketing, gas stations, the marketing side of it. That sort of business, it has been an extremely profitable engine for them, where like ExxonMobil and Chevron, they've kind of been shying away from, I guess you could say, frontier markets for a lot of its refining and marketing. So encouraging to see them to be able to do that profitably. And, Total Energies is really, really pushing hard into the LNG space right now, kind of on that thesis of natural gas is going to be a bridge fuel. As we transition to renewables, it's going to be that stopgap measure that's going to help get us there. And, has been an immensely profitable trade for them, as well as in terms of building out new facilities. And if we look at, like, for example, European changes in the natural gas market, it's been something that looks like it's going to be a long-term winner, simply because it changes the dynamics of energy for places outside the United States that aren't as blessed with energy security as we are in the United States.